Okay, good morning, everyone, and welcome to this month's Small Business Webinar. My name is Paul LaChapelle. I'm with Montana State University Extension, and it's my pleasure to welcome you all to this month's webinar. Today's webinar is sponsored by the Small Business Development Centers, which are affiliated with the Montana Department of Commerce and the U.S. Small Business Administration, as well as the Montana Economic Developers Association, MSU Extension Community Development, with additional support from the Great Falls Development Authority and the University of Montana. I posted some tech support numbers and an email there. If any of you have questions, want to get a hold of me, feel free to just reach out via that those contact numbers and email there. You will have an opportunity to ask questions and comments, provide comments at any time during the presentation, and I'll just interrupt our presenter with those questions or comments. So please do type those into the Q&A box, and we'll get those addressed straight away. So now it's my pleasure to introduce today's presenter. Tom Kerr is the Senior Investment Specialist with Westpac Wealth Partners based in Missoula, Montana. Today he's going to be talking about business valuation, more art than science. So Tom, I'll turn it over to you. Thank you for joining us today, and go ahead and take it away.
All right, thanks. Can you guys hear me loud and clear?
Yep, you're coming through great.
All right, I'm actually moving locations here. Just by way of background, I've been in the financial services business over 25 years, covering investment management, wealth management, financial advisory, a whole gamut of it. And I've also done a lot of pro bono business valuation work as well for various small businesses. So anyway, it's great to be here, and thanks for having me. I'll get started and jump right in here. And just by overview, as the title says, business valuation is more art than science. It's when you're dealing with the complexities of small businesses and the accounting and the family type businesses, all the way up to mid-sized business. When you're doing a valuation for either buy or sell or minority interest, it's not as simple as one would think. You know, no business is ever worth $855,000.32, right? It's a range of values. You might use different methodologies. So it's a little complex, but the point is to get somewhere close or get in with this range of value. So let's look at the agenda on the next slide here. So first, I'm just going to do a definition of what is fair market value. And then the next 5 are different methodologies you can use to value a private business. Book value, adjusted book value, capitalization of earnings, discounted cash flow, comparables, you know, what other companies have sold or been bought in that related industry. And then we'll talk about a few discounts that would apply to these various conclusions or different methodologies. And then we'll just summarize it and open it up for questions. And as Paul says, you guys are welcome to ask questions during this as well. We can make this interactive if you want. All right, first of all, just sort of going to the start, what is fair market value? And I'll just read this according to the U.S. Treasury regulations. You know, the fair market value is the price at which the property would change hands between a willing buyer and a willing seller, neither being under any compulsion to buy or to sell, and both having reasonable knowledge of the facts. That's a typical government jargon, and it is true, but that has nothing to do, or is not really directly related to what is the valuation or what is my business worth. You know, it sounds easy in theory, you know, what's the price a business would change hands on, but you need to know a valuation and various estimates before that even happens. So a definition, explanation, a government regulation is not the same thing as providing a valuation. Now, the IRS takes it a little further and says when you are valuing a business or buying a business or selling a business, you should take these 8 factors into consideration. Number 1, the nature of the business and its history, right? What business are you in? What is the operating history? The next would be the external factors, general economic outlook, the industry outlook, what's happening globally. Couple more specific ones going across book value of the business and the general financial condition. You know, is there a lot of debt or liabilities? The earnings history is the next one, and the earnings capacity in the future. Can this business grow? Is it profitable? Then going out to the next level, have you got the dividend distribution paying capabilities? Are they paying their owners or other investors? Next one's a little more complicated, but it is important. The goodwill and branding recognition, or just the intangibles in a business. This could be brands or customer list, or just a recognizable business over history. Recent sales of an interest in a business, that's more into the comparables, as I listed earlier. What is the multiples or the valuations of very similar businesses, or partial sales of very similar business? And then the last one, which is sometimes used but not as common, is the valuations of similar businesses that are publicly traded, in other words, in the stock market. Sometimes with larger companies, you can get relatively good valuation comparables from the stock market itself based on the industry that you're in. All right, let's dive into some of these factors real quick. All right, this one is the first simplistic one, the book value, and that's simply assets minus liabilities equal your equity or your book value. It's the simplest method, but it's rarely used. Sometimes this is even called liquidation value. But the problem with this is the historical cost and the depreciation factor. If you have equipment or factories or homes that have been depreciated over long time periods to almost nothing, then that provides an unusually or low valuation because it could be depreciated to nothing. But you would have to adjust that to market value in some instances, which is the next one. So the IRS doesn't like this one as well, because sometimes family-related transactions use book value to sort of transfer the value of a business to family members at a very low cost. And there's complications with estate taxes, gift taxes, income taxes. So if someone's trying to sell a business low instead of high, sometimes they use book value, but it's very frowned upon by the IRS. So the next one you have is adjusted book value, right? If it's a simplistic business, not too complicated, not a lot of goodwill, not a lot of brands, you can adjust those assets based on fair market value, right? So the previous example I used of sort of a factory or home or something like that, you can get fair market value appraisals or current appraisals that sort of adjust that book value. And that's more reflective of the true asset value. And you could have a reasonably good book value estimate of your business. Two problems with that is it does not, it does not reflect the goodwill or the brands, as I mentioned earlier, right? Customer relationships, intangibles, other assets like that could really make the business worth more on an asset basis. And then one of the biggest issues with both book value methods, it doesn't reflect future earnings or the growth of it, the cash flow, the earnings. What can we expect in this business going forward? So these two methodologies are rarely used. All right, let's move on to another one. And here's a slightly more complicated one, but commonly used, and that's the capitalization of earnings. And this is kind of the inverse of a PE ratio if you're familiar with stock market type valuations. So let's say you earned a certain amount of net income the prior year. You can divide that by a capitalization rate and get the business value. And it's just a way of saying what that business is worth. It's sort of a reverse multiple. So let's say you earned $100,000 in cash flow last year and your capitalization rate is 5%. It would equate to a $2 million business value. And if you do the inverse, the 1 over 0.05, that equates to sort of a 20 PE ratio. The important thing here is the higher the cap rate is the lower the value. And the cap rates are often very variable too. It depends on recent transactions, what other companies have sold for. But if you have a very high cap rate, it's usually either risky business or it's not a growth business. But cap rates nowadays also track current prevailing interest rates, the Fed funds rate, lending rates. So during low rate environments, there's actually high valuations for businesses that you can obtain. That's based on a strong economy, what's happening in the overall market. Now the challenges with the capitalization of earnings is which ones to use, right? Do you go back 3 years? Do you use the current year? If it's a fast growth business, should you go out to your projections 5 years from now? Some people average the last 5 years, some people just take the current year. But of course, if
you're growing very fast and your earnings are going to increase over the next 3 to 5 years, and maybe that's not appropriate. So it's kind of a static type of valuation, but it still works. And then just what rate to use, as I mentioned, what's typically used is the risk-free rate. You usually use the 10-year Treasury bill, which is around 2% right now, and you add an equity risk premium. An equity risk premium is a little complicated word that really just defines how risky the company is, right? If it's a small company with volatile earnings, not a great management team, maybe not a good product, then you're going to have a very high equity risk premium. And sometimes in small businesses, it can be high as 20 to 25%. So in that example, your cap rate would be in the 20 to 30% range. And then for very small sort of mom and pop type businesses, you do see those high valuations, or low valuations, I should say. All right, so now the thing we've been missing now is, what if you are a growth business? How do you recognize those next 10 years of rapid growth? Right, if you're selling the business and the buyer doesn't think it's going to grow, then that's not a good thing for the seller. So the best way to capture this future growth is through a discounted cash flow. Now this is a little more complicated. You really need a spreadsheet for the most part, Excel spreadsheet. There's also some online modeling. Business appraisers have their own type of models. But what it really does is just capture that future growth. So here are the inputs on the second thing down. Forecast of future cash flows. So for this, you have to have a nice, usually 10-year projection of your earnings. And it can be detailed as complicated as you want, but you really want to forecast out 10 years to the best of your ability what this business is going to look like in terms of sales, margins, profitability, free cash flow. And at the end of the 10-year period, it's typically 10 years, you get a residual value, like what is the permanent or terminal value of all these cash flows going out forever. And then the other major input includes the discount rate. And we talked about that a little bit on the previous slide, but what do you discount back these cash flows on? Because when you're projecting out into the future, you have to discount those rates down to the present. And so once again, a low discount rate will give you a high valuation. And a very high discount rate, which you see in small businesses, usually double digits, will give you a lower valuation. And just to digress a little bit, the way the stock market is valued now, the publicly traded businesses, the interest rates are so low, the valuations are very high. And that's sort of one of the reasons you see the stock market at all-time highs, because they're discounting back at 3, 4, 5%, which is, as we know, abnormally low interest rates that we are in right now.
Question, if I could interrupt you.
Sure.
The question, hopefully you can hear me. The question is, when you reference earnings, are you referencing or referring to gross revenue, net income, EBITDA, etc.? So again, when you reference earnings, are you referring to gross revenue, net income, etc.?
Right, that's a good question, and it depends on the methodology that is used. For example, if you're talking about a discounted cash flow, you probably want EBITDA, or the rough equivalent of that in small businesses is seller discretionary earnings, or the old SDE. So that's typically your earnings plus owner salary, add back unusual items, and if you have amortization and depreciation, you can add that too. So it's basically the operating cash flow of the business when I say earnings. But that's a good question. And a lot of these small businesses don't have tax issues, so you don't have to add back taxes. But it's typically one of the 2 or 3 definitions of operating cash flow. So just hope that answered the question. And I could do a whole nother presentation on the earnings of small businesses, and what are the proper ones? Is it after tax, pre-tax, pre-cash flow, adding back amortization, adding back owner bonuses? So there's a whole nother sort of study or approach to owner or earnings. All right, so going back to the list on the left, it is relatively sophisticated. I mean, I think Excel does a pretty good job, and there's other online models. But the problem with this, and there's never, as usual, there's never a concrete answer to valuation. It's subject to overly optimistic projections. You know, every business owner thinks their business is going to grow nicely, X amount. Oh, I can grow 10% a year for 10 years. Well, 10 years is a long time. You may not reach that. So when the owner puts in 10% cash flow or whatever the earnings growth is, that could be overly optimistic. You don't know what's going to happen. Is there going to be a recession? Is there going to be problems with the products or the industry or the economy or market? So when you do these, you really want to be reasonably conservative. You know, if you have grown the business the last 10 years at, you know, whatever the number is, 10%, you'd probably want to say the next 10 years will be 5 to 8%. And I'm just making those numbers up to point in the right direction. But, you know, there's obvious limitations of size, competition that comes into the market. So if you are doing discounted cash flows, try to be a little conservative on the growth projections. And then likewise, be conservative on the discount rate, right? And when we do these for actually publicly traded companies, we do a lot of discount cash flows in my regular career. There's no way we would discount at today's rates, right? The 2% 30-year, the 2% 10-year, historically low rates. Some say there's a great report out where these are the lowest rates in roughly 2,000 years. They go back that far where there's ancient records of interest rates, and they've never been this low in world history. So if you put those low discount rates into a discounted cash flow, you're going to get abnormally high valuations. And some people think that's why the stock market is so high or unusually high or inappropriately high, because they are discounting back at very low rates. So when I would do this for a small to medium-sized business, I'm still conservative, because over 10 years, those rates could go up, and I think rates will go up over the next 10 years. It's hard to imagine they'd be this low forever. So one best way to be conservative is to just take a guess of what interest rates will be over the next 10-year period and sort of average those. I don't think it's probably not a wild projection to say they will be higher over time. So just be conservative in that higher discount rate. And then the last one is what I just mentioned, subject to interest rate anomalies. I think we're in a 10-year anomaly here in terms of low rates. So just be careful with that if you're using this methodology. And then this is one of the most commonly used one, is the comparables. You know, recent sales of similar private companies, recent sales of similar public companies, or sales of an interest in the same business. So there are companies out there, databases that track specific private business sales by industry, right? It could be a restaurant. You know, what do restaurants go for as a percent of gross revenues, a capitalization rate, multiple of earnings. So there's very important to look at that variability and see what, and this could be nationwide, and there's adjustments based on region or location or state or type of restaurant. But there is very detailed databases out there that track, last 2 or 3 years sales, and it could be narrowed down to, a car repair shop or something very narrow, or just a pizza restaurant. And you can see on average, these have gone for 3 times EBITDA or 4 times sales or whatever the number is. But that's very relevant because it's what's happening in the market. It's reality. It's not just projections or interest rates or growth or accounting with your book value or adjusted book value. These are real transactions that have happened in whatever the time frame is, the last 12 months, 2 years, or 3 years. And then sales of interest, there's a lot of minority transactions that go on where the whole business is not sold. So you can also look at that and see, I just sold half this business, so what can I do? All right, sorry about that. And also these comps can be used to determine capitalization rates too. Just, what is the equity risk premium? What are these multiples going for, et cetera. All right, so those are 5 good methods. And once you have sort of the valuations, the numbers, maybe a rough estimate, there are things that you have to discount. First one is minority interest. Obviously, if you own less than half the business, you don't have the voting power, you don't have control. So minority interest valuations would warrant a discount. And that's based on recent transactions, based on other factors. But if you're selling a 30% interest in a business, that would not be the exact same valuation if you were selling 100% of the business to an independent buyer. Lack of marketability. Is this a product that people still like? Is it sellable? Is it not really a viable product? And someone mentioned this the other day. What if you're buying a vaping business, right? I think those valuations just went down incredibly, and I think in the publicly traded markets they did as well. That's a non-marketable business right now. I don't even know what they're called, vaping products or something like that. But that's a good example of things that maybe you just can't sell it, so your discount's going down quite a bit. Management departure. If this is a reasonably sized business with employees and you have a CEO that's really driven the business, really, found the foundation for growth and really just turned this business around, and he's leaving and not coming with the business if you were to buy it, that's obviously a discount factor that you would have to put into these valuation methodologies. So there's a lot of key employees in a lot of these larger businesses, not the smaller ones, but most of the larger ones. It's something to really watch. And a lot of times they'll just have management contracts that will be mandated by the new buyer to avoid that discount. And then, of course, product obsolescence, which is similar to the second one, the marketability. But, are people buying products that are taken over with new technology, or is there something that just doesn't work anymore? Obviously, an important thing is that a marketable product or service going forward, or is it just sort of a dying business? All right. And then this one you can't see, I apologize. This is a spreadsheet, actually created this. So maybe one method doesn't work, but there's nothing wrong with combining 2 of those methods or 3 of those methods, or all 5 or 7 or whatever many are out there. Just get an average or a range of values. Like I said, you can't see this one, but the first one is a multiple of operating income. The next one is a percent of sales, which we didn't even talk about. So a lot of valuations on very small businesses is simply just a percent of gross revenues or percent of sales. And that you'll see a lot of databases around the country on that simple metric. The auto dealer shop or the auto body shop went for 0.6 times gross revenues over the past 3 years. That's another one. And then there's a discounted cash flow. Then there's a book value. And you can average these and just get a range. For here I did, this is a little bit old, this was last year's earnings and estimated this year's earnings for 2019. And that's a pretty tight range you can see. And like I started with, you're somewhere in the ballpark of this. And you could just take 2 of these. It depends on the industry where it's appropriate. But, don't be afraid to sort of look at all these and just get a guide where you are. If one comes out significantly less, maybe that's not appropriate for that business. But the point is, when you get these valuations and you get this average or this range, see, I think this one's, gosh, I can't even read it, 2.2 to 2.3 on average million, but the individual valuations come from 1 million to 2 million. And if that's what you think the business is worth, and you're trying to sell this business because it's yours for $5 million, you're probably a little bit off somewhere. Or if a buyer comes in and says, hey, I'll just pay $800,000 for this business, that's sort of a lowball price, because your average methodology seemed to show a sign that it's probably worth more than that when you look at all that. All right, now we're sort of on the last slide. I think we've got a few minutes left. So just in summary, the business evaluation, the stakes are high and mistakes can be costly. Make sure you cover all your bases. If you're doing it yourself, look at the best appropriate methodologies that you can. And it may be appropriate to hire a business valuation. There's quite a bit of services out there that do it for you. If you have complicated accounting, somewhat of a larger business, maybe it's also a family business, an experienced appraiser may be necessary. And if this is a large sum, we're talking about many millions in a business, you may want to even hire 2. And usually a buyer can hire 1, a seller can hire 1, but just getting 2 appraisers that actually do 3 or 4 different methodologies and then average those, it's just important to get the numbers right. Just backing up a little bit, there's not one single best solution for all companies or all businesses. It could be large, medium, small, it's the type of industry you're in, your earnings, management. So there's no single best valuation solution. You really got to sort of run the gamut and see what's appropriate. Make sure you consider internal and external factors. We didn't talk about that much, but you obviously have to look at the business, the earnings, the cash flow, the margins, but it's important to look at the external factors, which is the actual environment you're in, both economically and in the industry. Is the industry just getting too competitive, or is it a dying industry? Is a recession around the corner? You know, right now we're at 11 years of economic growth and stock market growth. I think valuations are going to be really high. It's maybe a good time to sell a business, not buy. So consider the external factors and where we are in the economic cycle. You know, nobody can predict where we are. Nobody can predict where the recession is going to come, but we are probably closer to the top than the bottom when you're looking at the big picture. And then lastly, don't forget about the IRS. This is where it pays to have a really good accountant or tax planning advisor in this sort of system, especially if it's a large amount. They can be really tough on family transfers of businesses. They can be tough on how you recognize earnings. All this plays into gift taxes, estate taxes, personal income taxes, corporate structure issues, the LLC, the corporations. So if this is a pretty decent sized transaction, or even a small one, make sure your CPA or your tax planning attorney gets involved at some point, not just the business valuation guy, so you don't get in trouble with the IRS or various specific government regulations that also cover this area of valuation and business transfer. I think that's it. Disclaimer. Sorry, I was talking fast, but
Great, Tom.
yeah,
Thanks,
I'm open to any questions if you guys have them.
the great information. We've got a number of questions that are stacking up here. Let me just read them out to you. The first one, is there an online publicly accessible data source you'd recommend for identifying cap rates by industry? And let me know if you want me to repeat that, Tom.
Yes, there is. I don't have that on me. If you can email me at that email, I'll give you some of the best choices, but I don't have those memorized or the website memorized right now.
What databases do you recommend for finding recent similar business sales and purchase prices?
I'm afraid I'm going to have to answer the same way. Sorry. I'm sort of standing up here at a conference in Portland, so I don't have access to my database information. But I can, if you can email me those, I can show you the right ones. In my firm, I'm not here to pitch my firm, but we have very advanced business planning valuation tools if someone's ever in the need for a medium-sized business valuation. But the online sources, there are quite a few, but if you can email me or call me, I'll be happy to give you those.
And you can see Tom has posted his email address and phone number there in the on the screen. Another question, please address the cost an entrepreneur might expect to pay for a high quality valuation by a qualified professional. Again, please address the cost an entrepreneur might expect to pay for a high quality valuation by a qualified professional.
Yeah, that's of course, the answer to that is going to be it depends, like it always is, but depends on the size of the transaction and the size of the business and the complexity of the business. If you're a small mom and pop business with 2 employees, I mean, you could hopefully get it done for $1,000 or under. But there are business valuation companies that look at 50 employee companies, family owned, that have been around 20, 30, 50 years, and you could pay anywhere from $10,000 to $50,000 to get that valuation right. And it's usually, I wouldn't say always, but usually a great investment because you don't, the valuations they come up with could be under off by millions. So investing that $1,000 or $5,000 or $20,000 to get a proper valuation when you're talking about $1 million business is probably a good investment.
Great. Thanks, Tom.
Most of the time.
Another question, do you include, and if so, how, the value of digital assets like websites, social media accounts, and customer lists?
Sure, and that mostly falls under the intangible asset part of it. A customer list is very valuable, and there's no specific dollar value that would be put on a balance sheet from a literal standpoint, but there's ways to value that customer list. If you have a 1,000 customer list and it's a recurring revenue stream where 90% of those customers are buying a product or service every year, there's an incredible amount of value to that. So yeah, those can be put on the balance sheet, and some of those are one of the areas a professional business appraiser can actually help with on a specific matter. They know intangibles, they know what your brand is worth, and it's a tough calculation. It's based on a lot of different discounted cash flows related stuff. And sometimes you see it on these large publicly traded companies where I think Coca-Cola's brand intangible was valued at $50 billion or something extraordinary like that, because it's the most recognizable brand on earth. So they were able to put something, I might be off on my numbers, but like a $50 billion valuation. Same thing, if you've got the top restaurant name in your local city, that's worth something that may not show up in a hardcore book value type valuation. Oh, they always asked about digital assets. Sure, that's a tough one. I actually don't know the answer to that, how you define digital assets. Website is worth something. What is the traffic? Do you get money from it? I think it's almost the same type of thing, but that's a great question. And I'm sure that some business valuation firms actually specialize in digital assets as well. But it's a little bit of an advanced question for this
customer lists
forum.
were also mentioned. Not sure if you have any comments about a customer list.
Yeah, that's kind of what I touched on at the start. Very valuable, and it depends where those customers are actually paying something. Are they recurring? Is it a monthly revenue stream? Is it just names you reach out to? So that's definitely part of the valuation, and it just depends on the individual situation with those customers and how much they spend and how loyal they have been.
We'll give folks another minute to type in a question. If you would like to do that, I'll just remind you our next webinar is Thursday, December 5th. Again, the same time. Our presenter will be Jason Nitsky, our Regional Director for the Great Falls Small Business Development Center and the Great Falls Development Authority. He'll be talking about turning a hobby or passion into a side business. And the title of that webinar is Start Your Side Hustle. So look forward to that on December 5th. Also, if you'd like to join our listserv, please just send me an email. My email address is at the top of the Q&A box there, and happy to add any of you to our listserv. Again, I'll be posting the recording on our website in the next day or so. Again, last call for questions. I don't see any coming up, Tom. So with that, here's one last question that's come up, Tom. Is there a general formula
Sure.
to follow when valuing a business? Should a small business purchase price be able to pay for itself over the next 10 years?
I think I understand the question. It depends on your needs for your return, right? And some people buy business they want a 25% return every year. So in 4 years, they'll have their essentially business paid for. But it just depends on the needs of the individual buying it. There's no rule of thumb. I think 5 years is probably a decent one, right? I want to get enough cash flow back over 5 years to essentially pay for the business. And the other perspective is if you're using all debt to buy a small business, what are the terms of that debt, right? If it's a 7-year note, then you obviously want to have that cash flow pay off that note within 7 years. So those two are kind of interrelated. But it just depends on the transaction and the individual investor return needs.
Right, just to follow up, the individual says through business cash flow. Yep, the business return pay. Can the business return pay for itself over a reasonable time frame?
I'll say that is the goal. You want to own the business free and clear, and we pay your purchase price as soon as possible. And it just depends on the cash flow of that business. Some businesses are low margin, low cash flow, and it might take 10 years. And some businesses just gush cash flow, and you can do it in 3 years, obviously depending on the price you pay for it.
Well, again, Tom, thank you so much for the great information. We've got one more comment here. Would it be fair to assume that the assets included in the sale may have relevance on the term of the return? I can read that again.
Yes. I don't know the specific details of what that would mean with that question. But yeah, the more valuable assets, if you just built a brand new factory 2 years ago and you're buying that business, that's going to obviously increase the valuation of what you're paying for it. And it's the same answer almost like I had before, where each asset's going to cash flow differently. If it's equipment or home or whatever it is, yeah, that's certainly something to take into consideration.
Okay. Well, why don't we cut it there? Tom, again, thanks for all the great information, particularly with you traveling and having to deal with kind of an uncertain setting for doing this presentation. You've been a trooper walking around and presenting the information. So thanks again for that. And for all our participants, thank you for joining us. We'll see you next month on the Small Business Webinar, and have a great day, everybody. Thanks.